This voice is taken from an article with the title, How to Use Macroeconomic Trends for Long-Term Risk Management, which has been published on TraderTalks.net. When it comes to long-term risk management, it is important to understand how macroeconomic trends can influence your trading decisions. Macroeconomic trends refer to the broad economic indicators such as GDP, inflation, unemployment, moveme, supply, and interest rates. These factors affect the movement of the financial markets, and thus, traders must be aware of them in order to make informed decisions. In order to use macroeconomic trends for long-term risk management, traders must first understand the fundamental concepts behind the different macroeconomic indicators. This includes understanding the underlying economic principles that drive each indicator. For example, an understanding of the relationships between inflation, GDP, and money supply is essential for making informed decisions. Once traders have an understanding of the fundamentals of macroeconomic trends, they can then begin to develop a risk management system that takes into account the macroeconomic environment. This involves understanding the current and future trends in the financial markets and using these trends to develop a risk management strategy that is tailored to the individual trader's needs. When looking at macroeconomic trends, traders should look at the current and future state of the economy. This includes looking at current and future trends in the GDP, inflation, unemployment, money supply, and interest rates. In addition, traders should also look at the current and future state of the stock market, bond market, and foreign exchange market. By understanding the current and future state of the economy, traders can gain an insight into which macroeconomic trends are likely to impact their trading decisions. Traders can also use macroeconomic trends for long-term risk management by looking at the current and future performance of the currency pairs they are trading. Currency pairs are typically affected by economic events, and so traders should be aware of the factors that are likely to affect their trading decisions. This includes looking at economic indicators such as GDP growth, inflation, unemployment, money supply, and interest rates. In addition to looking at macroeconomic trends, traders should also consider the impact of geopolitical events on the markets. This includes looking at the political and economic stability of countries, as well as the impact of conflicts and terrorism. By understanding the current and future state of the geopolitical environment, traders can gain an insight into which events are likely to have an impact on their trading decisions. Finally, traders should also consider the impact of technical analysis on their trading decisions. Technical analysis involves using charts and other tools to identify trends in the markets and determine how likely a given asset is to move in a particular direction. Technical analysis can be used to identify potential trading opportunities, as well as to identify risk levels and potential entry and exit points. By understanding the fundamentals of macroeconomic trends, traders can develop a risk management system that takes into account the macroeconomic environment. This will enable them to make informed decisions and take advantage of potential trading opportunities. In addition, traders should also consider the impact of geopolitical events and technical analysis on their trading decisions. By doing so, traders can ensure they are making the best possible risk management decisions and maximizing their long-term profits.